Hey folks, hope everyone is doing well today. We want to look at Google Sheets rather than Apple numbers. I've been working on this a little bit. People have been asking why I use Apple numbers comparatively to Google Sheets, and I didn't really have an answer for them other than trying to track things in Apple numbers was a little bit simpler. But lo and behold, there's pros and cons with both using Apple numbers and pros and cons with using Google Sheets. We'll touch that throughout this video, pros and cons of each. But before anything, basically want to give you guys an overview of the portfolio utilizing the Google Sheets, which is something that I may or may not be continuing to use in the future, but wanted to give a practice run on seeing what it's like to present from this compared to Apple numbers, and then give you guys a brief overview, obviously, which is something I'm going to be doing, give you guys the intro, and then obviously we'll be going sector by sector, basically what positions are in each individual sector, so that you guys can get an idea as to what I'm invested in, when I invested in them, which is something that's very important for some of you guys that are looking at some of these videos, might be looking at, say, Waste Management or any of these other companies that have run up drastically over the past couple of years, and seeing it in people's portfolios and automatically saying, well, Matt Money has it, other people in the community have it, I should be buying it, when they don't necessarily know when I purchased it, when somebody else purchased it, and if it might fit or not fit into your portfolio. So those are huge things you need to be considering when analyzing a stock or seeing somebody having a stock in your portfolio, making sure you do your own due diligence and making sure if it's right for your portfolio. So going into the actual portfolio overview here for me, utilizing Google Sheets today, portfolio here is at $403,000, $270 if you guys want to really get specific. And this was updated recently, so benefit of Google Sheets here is that it's instantaneous, might be 15 minutes delayed or so, but everything's relatively cleaner with respect to that. No waiting a few hours for market close to get an update or anything like that. You guys that have been following the portfolio and following the channel a little bit recognize that I split my portfolio into two big categories: the dividend portfolio, which is what shows up in these beautiful pie charts here to the right and the top and bottom of the screen, and then 128,000, which is my 401k, which doesn't really allow me to make beautiful pie charts, kind of like what you're seeing on the screen here. It's basically just one big fund, and so I can't really split it up into what kind of sectors you're seeing on the screen here and what kind of charts you're seeing on the screen here. But that's something I might remediate a little bit later on in the year. Won't get too much into that right now. We'll just get back to the actual portfolio. So looking specifically at the dividend portfolio, dividend yield on it is about 4.26%, so just under 4.3% yield at the moment. Yield on cost, just based off the fact that the portfolio value is beginning to increase comparatively where I invested at, looking at about 4.8%. So this means that everything I'm invested in has now gone up in value, meaning that the yield at the moment has gone down. Hopping into the pie charts that you're seeing here, the top two are related to the split by sector. The one on the left is talking about income. The one on the right is talking about capital allocation and where the capital is within the portfolio, to kind of give it these sort of splits here. And the ones on the bottom are more talking about how it's split up by account, whether it's in, let's say, my Roth, whether it's in my individual brokerage account. All right, sorry, had to fix something really quick. So you can see that the charts here kind of changed. It was utilizing one of these row 24 here as headers, didn't want to do that. So you can see that the actual allocation changed here a little bit. You can see the individual brokerage account holds the majority of the value in the dividend investing portfolio. Mostly when we talk about that, we talk about that, and then we kind of follow up mostly with the Roth IRA, and then the remaining quarter of the portfolio is occupied amongst a couple other accounts, whether it's for trial and error, looking at Robinhood, looking at computer shares, looking at Cardone Capital, kind of split up into multiple different accounts where I'm trialing things out to see if I want to continue to invest. But obviously, things I want to continue to invest in year after year are my Roth IRA, my individual brokerage account. So going into how those are actually invested with respect to capital, energy is the largest by far at 18.3%. 16.4% in terms of financials, 14% in terms of real estate, and that's followed up pretty closely by healthcare and consumer staples. Consumer discretionary is kind of lagging behind, about 3%. Information technology is also smaller here, and if you look at this red, materials showing up in this orangish color here, it's about a little bit less than 4% as well. Telecommunications sector is kind of holding up on its own, just over 6%. Utilities is by far the smallest position, being 0.4%, and this cash is actually at about 7%, so there's nothing wrong with that. ETFs is a little bit under 1%, but that would be blanketed across the entirety of the sectors here because they are invested in things like total stock market fund, S&P 600 small cap, and S&P 500 funds. So those don't really discriminate against everything. It doesn't overinvest or underinvest into one particular sector. If they were to overinvest, it would probably be into information technology. So not that I have a problem with that. This is the way things goes, but just trying to highlight the fact that S&P 500 or normal ETFs that I invest in aren't sector specific. So I'm not investing in any energy specific ETFs, or I'm not investing in any industrial specific ETFs. So the income aspect of things, going over to the left pie chart here, doesn't change too drastically. Energy is by far the largest at over a quarter of the portfolio. That's down from over 30-ish% as that it was in the past. Reason being that it is still the largest is obviously it's just under a fifth of the portfolio in size, but it also has a pretty large yield by sector. So it's just under 6.5% in terms of yield. So that combined with its large portfolio percentage ends up being just over a quarter in terms of income. Financials is relatively on par with the size that it has within the portfolio in terms of capital allocation. And similar to real estate and consumer staples, healthcare is slightly a little bit less in terms of income compared to its peers, and I think that's going to become obvious as we're investing in, say, AbbVie as well as Johnson & Johnson. My large position in Johnson & Johnson is going to bring down that average yield of AbbVie by a pretty substantial margin. We'll get into that in a little bit. Industrials is up there as well. Materials is coming up pretty well. That's my investment in BHP as well as LYB. You can see that that brings the materials sector up from, even though it's just under 4% in terms of capital allocation, it ends up being about 5.6% in terms of overall income. And that's based off the fact that it's got a 6.3 yield as well. So it's comparable in terms of energy with respect to its yield by sector, bringing up that 4% or just under 4% in terms of materials to just under 6% in terms of income from this sector. Telecommunications kind of holding its own, very similar with respect to the size in terms of capital as well as the income we're getting. Cash is around the same. Cash is around just under 3% of income, but obviously it's coming in at just under 7% of the value of the portfolio. That's obviously because cash is weighted a little bit less comparatively to everything else in terms of yield. Currently, we're kind of sitting at a pretty low federal interest rate, so that drags the yield of cash into my personal savings accounts as well as some of these other accounts like Robinhood and what have you, down to the 1.7, 1.8% range. And so in some cases, Robinhood doesn't give me any percentage for my cash because at the moment I don't have the high yield savings account within Robinhood, and so I kind of just have a few dollars sitting there. So that is what it is. We'll kind of get into the intro here, and then we'll actually go into what positions I hold in each individual sector. So talk to you guys after the intro. All right, so progressing into the other part of the tracker that we have here in Google Sheets, you'll probably notice that instead of having multiple different tables like I've had in the past, it's one large table where I generally now filter on anything like whether it's accounts, which is here under column C, or anything else with that matter. So there is a little bit more columns associated with this. I added a little bit more with respect to delay because now the price should be rather real time comparatively to what it was in Apple numbers. You have market cap, which you're able to see earnings per share, price to earnings, stuff that I didn't have in here before. I'm experimenting with buy, holds, and sells here within the portfolio, and that's kind of giving this like weightings here. So if I were to change this to like a 10, it would hopefully change some of these as well. But it's kind of looking at the price to earnings ratio and seeing whether it's buy, hold, sell. It's something I'm going to be experimenting with other things as well, whether we're going to involve 52-week lows and highs and whatnot. Looking at average volume compared to the current volume for the day, annual dividend yield payout, um, dividend yield percentage, yield on cost based off of what I initially invested in, the payouts per year, which is one of the only manual things that you'll need to add in here, price paid per share, obviously, if you're investing in something. You're going to need to put in your cost basis, shares original and shares now, comparing to whether or not you're actually reinvesting dividends or not. If you're not reinvesting dividends, you just basically would keep your shares original, your shares now. And that's relatively it with respect to what you had to manually put in here. Everything else is newly calculated. You can kind of look at what the dividend payout ratio or the dividend payout would be when it's supposed to be paying with respect to if it was recently paid in the case of, say, Bank of Nova Scotia, or whether or not it will be paid relatively soon in the case of, say, AbbVie, which is supposed to be being paid on Friday this week, or in the case of BlackRock, sometime a little bit next month. And you can kind of understand what your next payment would look like. So this is based off the fact of how many payments you're expecting per year. So you can kind of get an idea as to, hey, on February 14th, I'm expecting 137 bucks. That's pretty cool. Trying to automate as well some of the previous things that I've been putting into the Apple number sheet. So we'll see how far I get with that. But then you obviously have your annual payout to help you calculate what your annual um, revenue will be from that. And then you have sector, which is generally pretty typical. Some of the dividend data where it's pulling the dividend data from that updates it relatively often. How you can see price open, price high, price low for the previous trading day, 52-week high, low, beta, shares outstanding, and how much you own in terms of the company. Obviously, you'd want to get this as high as possible, be able to get yourself a little bit of wiggle room in share ownership so you can start bossing people around. But in all seriousness, going into what the actual sectors look like and looking at specifically where we have some of these sectors in here, let me pull up the different filter that I had before so we can actually look at some of these sectors. So let's clear everything and let's keep sector, obviously, because that's the header. And we'll kind of go into consumer discretionary first because that is the one that we have kind of here at the very most top, and that is Walt Disney. So relatively low in terms of dividend yield. It's only 88 cents per payout, which gives me about $45 in terms of every time it gets paid, because that is semi-annual. You can see it pays about $90 a year, and really only has a 1.7 yield on cost, and that's just because I purchased it just over 100 bucks. Now it's hovering above 100 bucks. I think it's close to 140 or so in terms of what the actual price is. So $257 billion market cap, which is pretty cool. You kind of see what the PE ratio looks like here, earnings per share. Pretty confident in Disney going forward, so can't really scoff at that. Don't really plan on cheating out, or don't really plan on trimming a position or anything like that. And that's just based off the fact that, I think it's got a long-term growth horizon, and also Disney Plus is just in its infancy, so nothing wrong with that. Now going into consumer staples, you'll see a lot of different positions multiple times. That's just because they're in different accounts. So you can see I have things in my individual brokerage account, my Roth, my computer shares, my shareholder services. And so specifically Altria Group and Philip Morris, I believe you'll see in different accounts. So I wish I had something at the moment that can combine all these, but at the moment we have them as separate positions. That's just based off the fact that they're in different accounts. But looking specifically at Altria Group, we have approximately 139 shares in my individual brokerage account, and you can combine that with the 26 or so shares in my computer shares account. So that gets me about 166 or so shares, which is pretty cool. Combining that together, you get 467 plus another $90 in terms of annual income. That gives me about $550 in terms of annual income. That's pretty cool. Expected payout every single quarter would be about $139 or so, which is also a nice little touch. $78 coming from Philip Morris every single quarter. That would end up being about, if you were to combine both of these positions here, $420 every single year. Currently curious how many shares I have in total of Philip Morris. So I have 67 in my Roth IRA, and then I have about 22 in my computer shares account. That's good for just under 90 shares, which is pretty cool. It's a little bit higher price compared to Altria Group, but currently actually looking at a gain, which is kind of cool because for a while I was sitting on a loss, and I think this is just because the price has actually kind of come back up. I remember I was super ecstatic about 18 months or so ago when it had a horrible earnings report. It went from like $104 down to like $85 a share. It lost like 15% in a day. And I remember backing up the truck in my Roth IRA being like, dude, this is the purchase of all purchases. I'm going to purchase. It's going to be now. And so I purchased about 61 shares as it went down. And cost basis, as you can see, is about $92. So I think I had about 25 shares. I added another 30 or something like that, but brought my cost basis down to about low 90s. And so with dividends reinvested going from 61 shares to 67, we're finally up on the position. But I'm not really in it for the dividends. I'm in it, or not really in it for the capital appreciation. I'm more so in it for the dividends. So other positions within here, PepsiCo, that's done relatively well for me, up 53%. Expecting a dividend payment. Actually, we just got a dividend payment, so wouldn't be expecting another one for another 2 months or so. Getting me about $200 a year. Can't complain with that. Keurig Dr. Pepper is a relatively small position, so I won't go too much into that. Clorox is one of the best positions I've had, although it's also a relatively small position, just under 5 shares, so I wish I had more. And these other ones are somewhat auxiliary positions as well, so I'm not going to add too much commentary on those. Now going to the big boy, which I believe is actually, let's just get cash out of the way, and then um, we can go to energy positions here. So individual brokerage account, we don't really have any cash at the moment. Have about $554 in the YouTube Moolah account. $0 because of fractional shares in the Roth IRA. I just spent my last dime in my Roth IRA. And Robinhood, I have about $266 because I sold some positions in the Robinhood account, auxiliary positions I didn't really want to hold anymore, and some free shares that folks had gotten, that I had gotten from people signing up. So appreciate you guys continuing to use those. Then in $18,000 in the personal savings accounts, that's where I hold the majority of my cash. Currently getting about 2% yield, 1.7% yield every single month associated with this. So gives me how much a payout every single, I don't have it on here, but I guess 25 bucks a month, which is pretty cool. About $300 a year, which is nice. But obviously this is kind of a parking place until I decide whether it's something I invest in, whether it's real estate within the stock market, whether it's a private real estate investment trust, whether it's my own real estate, whether it's individual stocks. Kind of just a parking place at the moment. We should be getting a few more $1,000 parking here over the next couple months to add in as well. And this is kind of a point where I want to take a moment and recognize that at the moment, I generally speaking reinvest all my dividends. But now, because individual brokerage account and a Roth IRA that both sit under Fidelity offer fractional share investing, it's something where I'm kind of debating whether or not I now have commission free fractional share investing. I don't have to worry about if I were to pool my dividends, whether it's $1,000 a month or $500 a month. I can now immediately invest all $500 into a smaller position that might be at an attractive price. Whereas before, if I had to do that, I would have to pay the $4.95 buying fee. So 1% of the portfolio would automatically go to 1% of the portfolio would automatically go to commission fees if I were to spend, say, $500 in investing in stock. I would immediately lose $5, and the other $495 would actually go into purchasing stock. And so now I don't have that problem. So now I immediately get all $500 invest into whatever I want, and I can invest all that $500 into whatever stock I want, not having to worry about, oh, well, I can only purchase four whole shares or three whole shares or even one whole shares, depending on what kind of stock you're investing in and what the price is. Now I can say, hey, I want 1.25 shares of whatever stock, or zero point 0.5 shares, or 0.25 shares of Google, or zero point 0.3 shares of Google at say whatever price, and spend all this $500. I can do that now, and so that kind of gives me an idea as to if I want to continue to pool the dividends or reinvest the dividends. It gives me an option, which is nice. Whereas before, I kind of was just like, well, now I have the argument against, losing out on efficiency of capital due to paying commissions, not having fractional shares. So now you just have excess cash that's kind of sitting in the account waiting for you to get more dividends to pool. And so it eliminates those problems and now allows me to kind of think more as a bigger money manager and not have to worry about those problems that I was kind of seeing in the past. So a little bit of context on that, and curious how people think about that in the comment section. So make sure to leave your voices heard down there. So getting rid of cash and looking at energy, we can see we have a relatively large position here in energy. Let's just do a quick roundup. So I don't have everything displayed here, but of the port that I do have displayed here, about $40,000 or so in terms of total market value at the moment. And that is partially due to the fact that I have a lot of investments in energy stocks. I believe in energy stocks. They're high yielding companies. I somewhat feel partial to energy stocks because, one, I'm a petroleum engineer by background, so I kind of understand how the oil and gas industry works. Pipelines is something I'm very familiar with. And so, I don't have any competitive advantage to anyone else. I can read the balance sheets just like everybody else. I don't have any, I guess, insider knowledge about any of these gas companies. And so the reason why I'm disinvesting is just because I kind of feel comfortable with what I do on a day to day basis, and makes me feel good that I'm investing in something that I kind of know. And so I guess I have a false sense of security around investing in energy and oil and gas stocks. That being said, I have a pretty decent portfolio around BP, Shell, Exxon that you guys can see here. And so no favoritism amongst any of these. In fact, I actually might get rid of some of my BP, invest a little bit more into Shell, because I did recently sell some of my Shell, I guess about a year or so ago, and now it's a little bit lacking compared to my Exxon and BP, and my BP has kind of grown a little bit over time. So might want to adjust that just so they're kind of more even in terms of position. But getting into the companies I have and how much they're actually paying me. So BP, the actual public liability company, is paying me about $591 a year, $694 additionally if you're adding midstream partners, which is wild. Chesapeake doesn't pay any dividend. They cut the dividend. I've almost lost my entire investment on this. This was something I purchased back in late 2014, 2015. It is what it is. You can't win them all. Cheniere Energy Partners pays me about $161 a year. That's pretty awesome. Icon Enterprises is a small company. I've actually thought about cleaning these positions up. I'm basically broken even on these positions. And yeah, it might bring down the overall yield of the portfolio, but I don't really concentrate them on that much. And money can be probably used better elsewhere. Kinder Morgan down a little bit on this as well, almost $1,000 down on this, but still pays an annual dividend and it's increasing it year over year. Cosmos Energy is something that I'm down on as well, but this is a kind of a long-term speculative play. I think it's a smaller E&P company that's kind of exploring new basins, and so if they do win, they might win big and eventually potentially get bought out by a larger organization, whether it's a super major or whatnot. But we'll see if I continue to hold on to this for the long term. You have Phillips 66, which is a downstream company. You have Royal Dutch Shell as well, pays me $228 a year. And that's basically it, except for Exxon. Exxon pays me about $375 a year. So that's pretty good. I mean, if you kind of add all of these up, It's about $2,500 in its own. There is one company that I'm hiding. That's basically just because some of the shares that I get as what I do on a day-to-day basis. So don't want to reveal that so everybody knows what company I work for. Um, so I'll basically just hide that at the moment so you guys can't really see that. And we will progress on to, let's say, ETFs because it's quick and short. ETFs, there's only three of them in the portfolio at the moment. Probably not even really worth spending too much time on. The only one that really has any significance is the S&P 500, or ticker symbol IVV, that I have here, and that pays me just under 40 bucks a year, or about 12 bucks every single time I get paid. Pretty cool. They all just paid me in December time frame, and that's really that. The only other one, I guess, is the ITOT and S&P 600, which is a small cap, which is nice. I like those. I've made a little bit of money. You can see 34% return, 12% return, and 23% return. So in that respect, doing relatively well in the ETF aspect of the business. Going to financials, this one's a little bit big as well, so ends up being pretty fun. Ends up being about how much of the portfolio in terms of dividends. So just under $1,900 a year in dividends. Some of these are larger positions, some of these are rather small positions that I'm beginning to build up, and so please be patient with me. BlackRock is one of those positions that I'm starting to build up. I have about 6 shares of this at the moment, and so hoping that this continues to grow with respect to dividend growth, as well as me continuing to invest at the right price. Unfortunately, now I believe that it is somewhat overpriced just based off of where it's at. I purchased it around $423 about, I want to say, a year ago, and it's since gone up about 35%. I don't think right now is the right time to be investing in it, but it is a great company for the long term, and so if there are any dips, I'm going to be sure to continue to buy. Yeah, Bryn Mawr Bank Trust. It's a local bank that I had when I was growing up, and so partial to it because it's a nearby hometown bank that I've invested in, as well as it looks like it's a pretty good buy. So they're continuing to grow their wealth management business. They're continuing to grow their local regional business, and as well as the fact that it's under $1 billion. And so I have a feeling that over time, it's probably going to be something that gets bought out. I believe that they have the moat and the wherewithal to withhold any sort of recession, as they've done since the 1850 time frame, or maybe it's even 1830 time frame, since they've been around. And so I don't feel like they'll go belly up anytime soon, but I think in the long run it'll probably be bought out by one of the bigger banks. And so that's my thought on that. Good enough for $210 a year. Bank of Nova Scotia pays me about $291 a year, which is pretty cool. Then you have Main Street Capital a couple times in here. So Main Street Capital pays me $346 in my individual brokerage account, and it pays me just under $400 in my IRA. If you combine those two together, it's about $733, which is pretty wild. Overall shares that I have of it are 272 shares, which is pretty cool. Pays me monthly, which is also pretty cool. So every single month from Main Street Capital, I'm getting about $61, which is pretty cool. That gives me the ability to purchase another share and a half, and that on its own pays me close to, I would say, another $3.50 every single month. So every time I have another month and another Main Street Capital reinvestment, it's another $3.50 in my pocket every single year that I can now count on in terms of dividends, which is pretty sweet if you think about it that way. You have US Bancorp, which is a position that's relatively new, and so I invested a little bit too early, but that's fine. I'm going to continue to add to this. I believe that it's a pretty good purchase price at the moment, which is why I purchased it about 8% ago. On the upside, actual PE is around 13. It was about 14% or 14 times when I first initiated the position. Price has gone down to $54. Man, I should purchase some. In fact, now that I'm talking about it, I might throw $1,000 or so in it now, just to double the position and get my cost basis down a little bit, get myself up to about 70 bucks a year. It's currently sitting at about 35 bucks a year. Wells Fargo, one of the larger positions. I think it's the largest position in terms of financials. $514 a year, good for about 261 or 251 shares. I just quoted it the other day. 252 shares, good for about $12,000 in total in the portfolio. Pretty wild. $128 every time I get a dividend payment, which is pretty cool. So I'm expecting one in just under 21 days or so, and that's going to get me another 3 shares or so. And so if you think about it, each share gives me another $2 or $2.08, or $2.04 rather. And so what that means is, another 3 shares, it gives me another $6 a year. So every quarter I'm getting another $6 added to my bottom line just because I'm reinvesting these dividends from Wells Fargo, which is a pretty cool way to look at it. Already touched on Main Street Capital, so going down to Visa. Visa's been something I'm purchasing to my M1 Finance account. So every month I'm adding, or every twice a month I've been adding $250 to the portfolio, and that's generally speaking been going directly to Visa as I'm trying to level out my Johnson & Johnson 3M and Visa as a third in the M1 Finance account. Been thinking about adding a fourth position to M1 Finance, but I haven't gotten around to it, so don't know exactly what I would put in there as my fourth position as well. Moving on to healthcare, we can kind of look at how AbbVie is being dragged down in terms of the yield overall by Johnson & Johnson. So currently 2 positions here, actually 2 pretty large positions, almost $11,000 in say AbbVie and Johnson & Johnson respectively. So probably closer to what position ends up being bigger competition, I guess, and running first. But I think it ends up being Johnson & Johnson, just based off the fact that I have a couple $1,000s worth of shares in another account as well. But looking specifically at AbbVie, we have about 116 shares or so that I've developed over, or that I've grown over the past couple of years, up to about $570 in terms of dividends. So it's just good for just under $150 every single quarter, which is pretty cool. Expecting a nice dividend check here in about 4 days or so from AbbVie. Then you have Johnson & Johnson, which the yield on Johnson & Johnson is a little bit less. You can see my yield on cost, obviously, for AbbVie is about 6.5% and 7% respectively, depending on what account you're looking at. But the current dividend yield now, just based off of a price raise over the past couple months, is actually up to, or down to 5%. Believe it or not, AbbVie is up to $95, which is pretty crazy because I was investing, I believe, in the high 60s, low 70s, and I believe at its 52-week low, it actually got into the 50s as well. So let's check. 52-week low. No, never touched the 50s, but it got down to the low 60s. So congrats to those folks, because if you did get in at 62, 66, you were at a 51% gain as of today's price. So pretty cool, but we are sitting just almost within 1% of all-time highs. So doesn't deter me. I think the Allergan merger is going to do really well for the company, add to its cash flow, add to its distributable cash flow, and also add to its pipeline with respect to psychiatric drugs, which is something that AbbVie has been lacking. And I think it's going to be a good synergistic effect between both. Johnson & Johnson, not too much to say about this. This is about $365 a year in terms of dividends, just over $92 in terms, or sorry, just under $92 in terms of quarterly payments, which is still a little bit less than owning 1% every single quarter if I reinvest the dividends. But overall, ends up being a pretty good chunk of a share, and considering each share yields about $3.80, it gets me probably another $2 every single quarter. So that being said, comparing this to AbbVie, it's literally half the dividend yield. So even though I might have a little bit more in Johnson & Johnson in terms of overall value, which is close to about $1,500 or so, the $1,100 or $11,500 position yields way more in terms of dividends than the Johnson & Johnson position, just based off the fact that it literally yields half. So pretty cool overall. You get to see two companies in their investment thesis and their stakeholder thesis and shareholder thesis. Johnson & Johnson, it's not like they're not raising the dividend. They raise the dividend like wildfire year over year. In fact, I want to probably put compounded annual growth rate in terms of dividends in here. So thank you guys for reminding me through making this video. But AbbVie has grown its dividend pretty quickly as well. I think that AbbVie just started out at a larger payout ratio than say Johnson & Johnson did, and even though Johnson & Johnson's revenue and payout continues to grow, I still don't think it's keeping up with the expansion of its net income. And so I still think payout ratio wise, this company, Johnson & Johnson, has a much longer way to go to continue to increase the dividend. But overall, both are paying out a lot of money in terms of dividends every single year. So you can't fault Johnson & Johnson. They're continuing to grow the dividend at double digit rates every single year. So it's not like they're holding back. I think it's just the fact that they're growing so quickly. They're trying to raise the dividend, yet they're still trying to be conservative all in one. So moving on to industrials, we have about 4 or 5 companies to cover in here. The first one I'll just touch on is 3M. It's actually two investments, one in my individual brokerage account, one in the YouTube Moolah portfolio, and then actually one in the M1 Finance account as well. Just under $400 a year in terms of dividends. The actual shares that we have is close to 66 shares overall, which is pretty crazy considering it's over $100 a share. Actually, probably at the moment close to $160 a share if you were to look over here. Then you have Caterpillar. That gives me, I think, about 38 shares of about $1 every single quarter. So annualizing that, you get about $157 or so in terms of yearly payouts from that. Icon Enterprises, again, is something I'm investing in. Might sell that as well. I think I actually have this split in another position under energy, so I need to double check whether it's industrials or if it's energy. So I might a little bit of adjustment there. Then you have Virgin Galactic. Doesn't currently pay a dividend, but can be a pretty high growth stock. And so curious what it's actually up to today in terms of price. We're up to over 20 bucks a share. Purchased it, I guess, a month ago for 15.50, maybe a couple weeks ago for 15.50. Figured, bought 100 shares in my Roth IRA, let it grow forever, see what happens. It could be the next Tesla of space. So you never know. Although there is SpaceX, I think it's going after a different market. I think this is commercializing space, allowing people to travel to one location to the next a little bit faster on Earth, cutting down commercial air flights. So instead of air flights, they'd be space flights, cutting down commercial flight, let's say a fraction of 3 hours, maybe comparatively to say 44 hours that it costs now or takes in time now for me to get from say Port of Spain, Trinidad, where I'm at now, to say Asia. If you could do that in say 3 hours, makes things a little bit economic. I'd gladly pay double the price, if not 3 times the price, to get there in less than 10% of the time of commercial air flight. So more to come on this. No current dividend payment, but pretty cool speculative play added to the portfolio. Then you have Waste Management as well. Relatively small position in the computer shares account. I believe I only have 6 shares, and it's gone up 160 something percent since I bought it. And believe it or not, just off 6 shares, I've made just under $500 in terms of dividends. Go to hold this one for the $500 in terms of gains. Go to hold this bad boy for the dividends in the long term. I believe they're going to continue to grow it. At the moment, it's making about $4.10 in terms of earnings, distributing about less than half of that in terms of annual payout towards the dividend. So pretty cool when you look about it that way. Only $1 or 1.64% of dividend yield compared to about 4% yield on cost compared to what I bought it at. Price paid per share is about 50 bucks. I remember talking to my buddy about this stock back in the day, talking about how Bill Gates owned it and it was 35 bucks a share and how it's a genius thing. I mean, Waste Management, everyone's going to have to throw away trash. And I should have listened to myself more and said, hey man, this is a good stock for the long term. I need to buy it. And here I am, 164% up, and I wish I bought more. And I think that's a lot of the case of a lot of positions that I enter into the portfolio. Now moving into information technology, we'll get that over with. And this was rather small, so I think there's only 3 at the moment. There's IBM, First Solar and Google. Google and First Solar don't pay a dividend. You can kind of see that here. At the moment, I have 4 shares of Google, which gives me about $6,000 or so in terms of market value, up just over $1,300 because I purchased them at just under $1,200 a share. First Solar purchased it just over $30 a share, currently up about 60-70% here. Like I said, no dividend associated with this one. IBM I purchased a long time ago, but sitting on it for quite some time. Purchased $4 or 4 shares, just over 4.5 shares through computer shares, and we've almost gotten our entire, I guess, share out of reinvested dividends throughout time. They have been diligent about raising the dividend. I think when I first invested in IBM, they were paying $1.05 or $1.10. So that being said, over the past couple of years, they have raised it 50% or so. But overall, it hasn't been a winning investment over the past 5 years compared to its peers. Only yielding about $35 a year in terms of dividends. I'm up $120, but that being said, that 17% over 5 years could have easily been invested in, say, something else that would have yielded me a lot more of a return. Nothing too crazy associated with information technology. Yes, you could say I've missed out on the boat on purchasing things like Apple, more Google shares, Amazon, what have you. I'm not going to lie to you. You're probably right. And by probably right, I mean you're 100% right. It's just not how I do analysis. I don't like to overpay for things. Apple, that being said, when it did hit its kind of value peak, I would say, and it was trading for, say, 10, 11 times earnings, that would have been a time where I should have invested. In fact, I did think about it. I just never ended up pulling the trigger. And so, hey, man, you can't win every single one, and it is what it is. So, going into BHP, looking at some of the material stocks that I have here. BHP is a really good position that I purchased back in 2015 timeframe. Purchased about 107 shares, and at one point I believe I had over 200 shares. Sold some of those shares for a break even. Now I've been reinvesting all those dividends up to 140 shares of BHP at the moment, up about 160% or about $3,700. Holding it for that dividend, man. Last year alone, I made over $700 or something like that in terms of annual dividends. I made the normal 400 some dollars in terms of dividends, and then had a special dividend in January of last year. And I think I made over a quarter of my investment back just from that alone. Of course, I reinvested it back into BHP, but now it's yielding me, if you think about it, $437 every single year on an initial investment of $2,300. So that being said, almost getting a 20% to 25% every single year if you look at it that way. Yield on cost at the moment, just based off of purchase price, is about 14%. But if you look at it in terms of how much I've reinvested, it's way closer to the 20 to 25% range if you were to look at it that way in terms of overall purchase, not just the purchase price per share. So pretty astonishing with that. LYB purchased a little bit too soon. But that being said, I'm going to hold it for the long term. Pays a pretty good yield, 215% every single year. Pretty cool with that. Yield obviously has gone up to just over 5%. Purchase at about just over 4.5%. So as I continue to get more dividends in the Roth IRA, I'll probably be adding to this position. Pays out 4 times a year. So at the moment, we're looking at about $54 every single dividend payment. So that in its own will continue to lower my cost basis in the position as it continues to reinvest. If you think about it this way, currently it's about $80 to $85 or so. And if it continues to invest at these sort of prices, we'll be able to get ourselves a couple shares every single year. So hopefully it kind of remains in this flat kind of area, getting me another 1 to 2 shares every single year, chipping away at this cost basis and eventually returning me back to profit. But like I said, investing it more so for the dividend, not really so much for the capital gains. Then you have a spin-off of BHP. Not really going to put too much time into that. It's less than $100 in the portfolio. Just haven't gotten around to selling it. Probably should at this point. Real estate is probably one of the larger parts of the portfolio here. So in terms of market value, overall value of that is close to $40,000 if you were to include absolutely everything. Actual payout comparing everything, putting everything together, is close to $1,700. So pretty cool associated with that. Have O in multiple, have Realty Income Group in multiple accounts. Um, been buying and selling it, unfortunately and fortunately, for many, many years. Have had success selling it, but I've also lost out on upside by selling it as well. I remember at one point I had over 200 shares of Realty Income Corp. Wish I never had sold it, but I did make a profit, invested in something else. I forget what it is. I was probably moving that money into my Roth IRA at the time and ended up making money on that as well. So can't really complain. It's just that it's hard to be able to see something kind of that you sold a position and continue to go up. And it's kind of a reoccurring theme as I talk throughout here that I probably should never sell some of these positions. And I haven't sold some of my energy positions. You can see, yes, you do lose some, but I would say the majority of cases you win a lot more times than you lose if you pick diligently and you fit your investments with the right strategy, and you don't just go in blindly. You do your due diligence and you say, hey, this looks like a great opportunity. You generally speaking will win more times than you lose. So anyway, get off my spiel there. This actually just raised the dividend a little bit, and that being said, you get about $10 every single month in terms of what comes out of my individual brokerage account, $1.23 in terms of what comes in to my computer shares accounts. That gets me $12 every single month from Realty Income Corp. And if you add all that up, it's about $144 every single year from Realty Income Corp. Pretty cool. Stag Industrial, it's a warehouse real estate investment trust. Originally purchased 100 shares. Because of reinvestment, I'm up to 126 shares, up almost 100% on my initial investment since 2014, and it's paying me almost 20%, almost 10% annual yield on my initial investment. So whatever $181 divided by $2,100 is, it's pretty close, but you can see the yield on cost is based off of the actual cost of each individual share, just under 7%, but I guarantee if you do 18 divided by 2100, it's probably going to be closer to, I guess, 8% yield every single year that I'm getting just from this position. Looking at Starwood Property Trust, it's a similar discussion, 75% growth on this, but have invested and grown the share count by almost 20 shares, from 50 shares up to almost 70 shares, yielding me about $33 every single quarter, $133 a year. Cyrus One also pays 4 times a year, gives me about $38 a quarter, $153 every single year. This has grown as well, almost 7 shares or almost 10% increase in share count just over the past 2 years or so. Relatively lower yielder in terms of real estate investment trust, but has continued to try to grow the dividend relatively swiftly over the past couple of years. Yield on cost is just under 4%. Just from this, you can see, we've been able to get a decent increase in terms of the investment, in terms of reinvested dividends, as well as price growth. You can see price paid per share is $50. We're currently sitting at about $62, and this is down from recent highs. I believe it was up in the 70s at one point, almost the 80s. If you look at this price chart here, up to 79.73 every for the 52-week high. So progressing on to WP Carey, it's a competitor, in my opinion, to Realty Income Corp, but it gives itself a little bit more international exposure than Realty Income Corp. So if that's something you're looking forward to, consider investing in it. It's up to about $93 for its 52-week high. So if you were to purchase it, it is down from its all-time high, so it could be a position where you purchase it. Don't really know what its price to funds from operations is at the moment, but I think if I remember correctly, it was a better buy than Realty Income Corp at the moment. Ignore this buy, hold, sell thing here. It's a work in progress, and you don't use buy, hold, sell or price to earnings for real estate investment trusts anyway. You use price to funds from operations. So ignore that for this particular case. But this bad boy yields me about $320 a year, about $80 every single quarter, which is nice. It means every single quarter I'm getting about another share in terms of reinvested dividends, which gets me about another $4 a year in terms of income. So every single year, or every single quarter rather, when I get my invested income from dividends here, basically buying myself another $4 a year in income, which is kind of cool. Realty Income Corp, we kind of touched that as well. Here's Fundrise, been adding about 130 bucks every single month to this, trying to get this close to $100,000 over the next 20 years or so. Currently yielding about 25 bucks a quarter, or just over 100 bucks a year. So continuing to grow that. Was at about 12 bucks last year in terms of the dividend payouts that I was seeing. So I've over doubled that just year over year. So that's obviously due to capital investment, additional capital investment, which I've almost doubled year over year as well. So hoping to continue to grow this into a couple hundred bucks in the near term and up to a couple $1,000s in the long term. Cardone Capital is something I'm invested in, about $15,000 worth. Don't see any capital appreciation or anything like that in the initial investment, but over time, when we do start to sell off some of these properties, I might see some of this investment kind of come back in terms of money that we get distributed back to our bank accounts. This is paying me about 56 bucks every single month. And so I see this hit directly into my bank account every single month. Still up for debate whether or not I actually own the real estate or not. I'm cautiously optimistic that I do. And it's not just some money fund where I'm basically getting paid, 4.5% or 6% on my money just so that somebody else can invest it in real estate and I don't get a piece of it. But we will see once I get the K1 a little bit later this month or next and see if I actually get depreciation from that. Of course, I don't think I have enough in an investment where I'd actually be utilizing that depreciation, but knowing that I get the depreciation in my K1 form will allow me to know that I actually do own a portion of those 4 or 5 investment properties that they have bought on my behalf in Cardone Equity 5. So a little bit more to come on that in the future. And then hopping over from real estate, getting closer to telecommunication services and almost the end here. Looking specifically at this, I have Verizon in 2 separate accounts. I have it in my individual brokerage account as well as my Roth IRA. It's good for over $350 a year in dividends, almost $8,000, almost $9,000 almost in terms of market value, over 145 shares in actual shares at the moment. Originally purchased about 131 shares, so we're up a good bit in terms of that. And luckily, I guess by the skin of our teeth, we purchased around a similar price point because we're up almost 40% on the shares. But I'm buying it for the cash flow, baby. So gonna continue to reinvest these dividends? Maybe, maybe not. Might take it and invest it in something else. But that being said, moving on to AT&T, this thing's kind of come down a little bit. I think it got up to the 40s again, if I remember correctly, at one point. No, almost 40 bucks though. So it's 39.70. So I guess it hasn't really come down that much. I thought it came down closer to 10% at this point, but it's a little under 3.5%, within 3.5% of its all-time highs. Currently yielding me about $116 every quarter, or just under $475 a year, which is pretty nice. So can't complain with that. And total yield at the moment is 6.66 yield on cost, 5.4% dividend yield, and that's slightly better than Verizon at the moment, which is about a 5% yield on cost that I have, and just over 4% current dividend yield. So in terms of what's paying me more at the moment, AT&T is paying me more, but overall, I think Verizon is a little bit safer in terms of a current dividend if I were to be buying. AT&T has been running up. I don't think their earnings have grown the 30% or so since I purchased it initially. But I think Verizon is currently a better buy, not just because this says so, but because of what I've been noticing about the price to earnings kind of expanding and contracting. Verizon's been relatively consistent about growing their earnings, whereas I think AT&T, while they are getting better about removing some of the debt that they still have a large amount of debt, and they have a little bit more to go in terms of expanding its net income, or the price needs to contract. I mean, 20 times earnings is not anywhere that AT&T should be kind of playing with. I remember when I first started initiating positions in AT&T back in 2013, 2014 timeframe, they were trading at less than 10 times earnings. So if you think about it that way, it's almost doubled in terms of the price that people are willing to pay for the same amount of earnings, and for no real reason other than the fact that, yeah, they kind of combined with Time Warner Cable and they have HBO now and stuff like that. But those aren't really massively growing business segments by any means. And there is a lot of competition with other, I guess, internet providers coming out in the long term. And so I think more of that will come into light um, over the next few years as SpaceX continues to invest in internet via satellites and things along those lines. So competition is getting fierce in that respect, and I think that's where a large moneymaker from AT&T and Verizon come in. So don't want to burst anyone's bubble on that one. So we'll progress onwards and talk a little bit more about utilities, which I believe is the smallest sector out of them all, and we'll round up the portfolio review here. Hopefully this one has been a little bit better for you guys, a little bit more organized, and you can kind of get an idea as to where you can look in timestamps for what singular sector, in case you're wondering. So at the moment, we're only looking at Southern Company and WTR Aqua America. This one actually doesn't show up appropriately within the portfolio. It shows up as West Core Energy. I don't know why. It's the only real mistake that I've witnessed so far in Google Sheets. But that being said, this one's kind of a moot point. I believe that the dividend payout might be relatively close to what it is, though. So getting around 25 bucks a year, I think, in annual dividends, so not too much from that. And then I only really have 2 shares at the moment of Southern Company, which is just under $5 a year in terms of dividend payments. So that being said, that kind of rounds out the portfolio. Looking at actual investment in utilities, less than 1,200 bucks. Nothing too crazy there. Haven't really made any money on Southern Company yet, so hoping to continue to grow a position as they continue to focus on their renewables portfolio. But hope that really helps you guys out with respect to what's in the portfolio and by what sector. This has been a fun little conversation, kind of showing you guys, walking you guys around the new Google Sheets tracker here. It's kind of cool. I like it. You could slice things a little bit differently. Like I said, there's not all the functionality yet compared to what I have in my iCloud or Apple Numbers tracker, because I haven't really gotten to the point where I'm tracking monthly dividends or anything yet. But I'm going to experiment to see if I can automate some of that, because in the past I've had to kind of set it up initially, and then if anything changes I have to change it, and so it was somewhat manual. It was mostly automated once you got it set up. But I'm curious if what I can do is look at some of the websites here, backlog and backlink some of these things, and say, okay, well, this particular stock is supposed to be paying on 1, 4, 7, and 12, or 1, 4, what have you, January, April, July, and September or October, and it'll basically set up your payments for those months for you. And if it switches, let's say, to February, it'll switch to February automatically, and you won't have to change that on your own. And that would hopefully eliminate some of the manual setting up the portfolio, as well as just in case there might be a special dividend that shows up, and you might not necessarily have caught it. It would show up in your forecast for you in 2020 and maybe not show up in 2021. So some more learning for me to do in trying to automate how I can help myself out, as well as potentially help you guys out. And so as we continue to get this bad boy up and running, I'm sure Kyle and I will make this available to you guys if you're interested. And of course, if there's anything that you would want to add into this sort of tracker that you don't have or you haven't seen yet, let us know in the comment section down below. We're more than happy to try to build that into the tracker for you guys, as well as to help me out track my own portfolio. So thanks, guys. This has been a fun run through, and I'm sure it's been a pretty long video, so I might split it into two, who knows, or maybe I'll just give you guys an hour-long special. But appreciate you guys stopping by the channel. I'll talk to you guys soon, and I'll see you guys in the next video. Cheers.